Hi, and welcome back to Detonation. Another great episode of Detonation coming right up after a crashing news week. And we got Andrew Reynolds, he's an accountant. He's a banking expert. He knows all about the numbers, the digits, what's happening in finance, economics. He's got it all. So we've got an expert on, and we're going to talk through the first news item today, which is the RBA again slashing rates, pounding those rates down, down, down. Lovely to have you on, Andrew, and thank you for coming on. It's going to be an exciting show.
It's great to be here.
Who are you, and what's going on over there in Perth? Is it?
Yes, I'm in Perth. I've been back in Perth since about 2003. Before that, I lived in London for about 7 years, working for banks over there. When I came back, I started working with.
You mean over here? You mean over here?
Yes, over there, with that rather nice erotic gherkin there behind you.
Thank you.
Although before that was built. But I worked for Bankers Trust, Deutsche Bank, NatWest Markets in London. And before I left to go over there, I was working for the Director of Public Prosecutions, prosecuting a bank collapse in WA that happened as a result of the WA Inc. scandal.
Did you meet Mark Carney? Did you say hi for me?
Not that I know of.
No. All right, let's roll into the first news item. So the RBA, so Philip Lowe, he's the governor. He's looking after Australia's monetary policy. It's a very exciting job. And to overarch this, I just want to remind the reviewers of what the RBA's role is, and it's a very important role. And Australia's central bank derives its function and powers from the Reserve Bank of 1959. Its duty is to contribute to the stability of the currency, full employment, that's a very important term, full employment, not unlimited unemployment, and the economic prosperity and welfare of the Australian people. It's kind of different to other central banks. Some just have, inflation targets and things. This actually says prosperity and welfare for the Australian people, which is kind of a big ask, if you ask me.
Yes, it is. It's a huge ask.
Yeah. So Philip Lowe has cut the interest rates to a historic low of 1% as it stares down the twin issues of rising unemployment and a slowing economy. The unemployment is about 5%. I think it's around about 5% now, and he wants to get it down to about 4.5% to boost wages and inflation. The 0.5% point cut comes amid fears of a global financial meltdown flowing from the European banks. And by the way, breaking news, Christine Lagarde is looking at becoming the ECB lady. Is she going to manage the crisis, or is she just there as put as to take the hits? What do you think of all that? They're going to target wages and inflation. Do you think that's correct?
No, I don't. I don't think the central bank should have a role in targeting wages. Personally, I don't know that there is a role for a central bank overall, but if you're going to have one, then their sole duty should be to ensure the stability of the currency, and that should be it. They shouldn't be trying to play around with the value of the currency to try and achieve macro policy goals. It's just not something that you can do. They have a very, very big blunt instrument, and to use your words, whack the economy with it to try and get it moving again isn't the right way to go.
What about Mario Draghi when he says we don't target the exchange rate? He said that about a week ago. Do you agree with that? Should they be targeting the exchange rate? Because if you're saying it's on monetary policy, on the currency, that's the exchange rate. Do you think they should be playing with the exchange rate?
The exchange rate really has two elements. One is the what your local currency. If we're talking purchasing power parity for a moment, what your local currency can buy, and that they should be targeting. The other side of it, of course, what the other currency can buy is really, to me, for another central bank or for another economy to worry about entirely. It shouldn't be something that one economy or you shouldn't be looking at the other economies to try and work out, well, how are we going to manipulate our money enough that it stays the way it stays, or it meets a certain arbitrary target.
So for the last about 10 years, we've seen the cash rate dropping here in Australia. We've seen it come down from, in 2008, it was around about 8%, and it's dropped because of they were trying to stimulate out of the GFC, what we now know as the GFC at that the Great Financial Crisis. Rates came up a bit. 2011, I think that they should have raised rates again in 2013, 2014. Do you think that that was a good time to raise rate and put more ammo back into the box, or do you think, because they've obviously been running with foreign central banks, haven't they? I mean, that's what that's what they've been doing.
Well, fortunately, at least the RBA has kept some margin above almost every other central bank in the world, and I can remember when the cash rate was over 17%. I remember it was quite some time ago now, but in Paul Keating's recession we had to have, which in many ways was the recession that was created by the central bank in trying to pump enough money into the economy too early, creating huge amounts of inflation, necessitating the massively high interest rates. So to me, the problem isn't that they're targeting particular things; is that they're targeting it all. Other than saying that, look, inflation should be inflation, depending on how you define it, should be zero. We should be able to trust that the money that we've got in our pocket today can buy roughly the same amount as it today as it will tomorrow or in a few years from now.
Do you agree with an inflation target?
No.
What about a small inflation?
Other than an inflation target of zero, the issue is, how do you define
what about
inflation
deflation? Do you worry about deflation?
I don't worry about it. I don't see small amounts of deflation as any worse or better than small amounts of inflation.
Yeah, I put that to you because people stress over deflation, but then they'll wait to buy the next mobile phone. And they don't realize that is deflation. That's the definition of deflation. They're waiting to get something faster, better, and cheaper at a future date. So I don't understand some of that deflation nonsense either. I do understand people mix up the term shrinkflation and deflation. They get that mixed up
and stagflation, which is even worse.
Yeah, exactly. And they mix these terms together, and then they put it all in the basket of deflation, and they say, "Oh, I'm stressing over deflation."
Yeah, to me, and I take a more I use Hayek more than just about any other monetary economist, and I look at what he says, and that I find it to be true. Money is the whole function of money is as information. It has nothing. It has no other real value in an economy. It is a way of working out the relative prices of things, and how much work you need to do to get that latest flashy mobile phone gives you a signal on whether it's worth buying that phone or not. So that to me is the way we should be looking at money. And if you're constantly mucking around with its value, trying to increase it, reduce it, do all sorts of other things with it, you're destroying part of the value of that money.
So you would leave up to the redistribution of money into the government's pockets, right? Because that's the forcible redistribution of money there. So you'd say, leave the redistribution up to the government and get the RBA and the central banks out of the redistribution of money.
Yeah, they should be just trying to make sure that the money has a stable value. Yeah, and that's a full stop. The issue then,
that's hard enough.
Yeah, that's hard enough, and that's quite a job, because apart from anything else, you're trying to work out, well, what is a stable value? Is CPI the appropriate, the Consumer Price Index, the appropriate measure of value? Do you use AWOT, the Australian Working Ordinary Time Earnings? Do you use, if a lot of the money is flowing into capital assets, do you use some capital asset price? Like the stock exchange value, and target that. What exactly is inflation? Is to me a perfectly, in fact, a reasonably important question.
Absolutely. So in the light of this news from the RBA, I've got a few points. So I said low inflation. There's high levels of inflation in the 1970s and 1980s have frightened central banks, and they're trying not to go back there. And that's why they have these low inflation targets of 2 to 3%, because they think that 2 to 3% they're going to force consumers to buy it in the now. They're going to force shoppers, but that's kind of I mean, ordinary, like for a consumer economy based on 70% of consumer economy here in Australia, it's kind of a bad argument. I mean, I don't really buy this whole fear of high inflation, excessively high, yeah. But like again, like the targeting 2 to 3%, it's kind of irrelevant, right?
To me, I think it's better that inflation is low and stable than it's high and unstable. Because again, using that hierarchy idea that money is there as information, the clearer that signal, the clearer the idea that the money is going to be at least predictable in value is a good start. If you can say that it's absolutely certain in value in some way, and the gold standard or some of the other possible methods of working out how to stabilize the value of your currency are good things to do. But at least have something that says, if you buy this basket of consumer goods this year, then that same basket of consumer goods next year will be 2% more. At least it's reasonably predictable and far better than the 17, 18, 20%, 25% inflation I remember when I was going through university.
Yeah, and it gives consumers confidence, it gives businesses confidence, and it gives government purchasers down in their bureaucratic remit in their departments down there more confidence, because they're more confident of larger, stable purchases, right? Because if you mess with small amounts, I mean, your purchases on huge goods, especially with the governments dealing with millions, hundreds of millions, and billions of dollars, that's a big move, right? Yeah,
it is, and you can overcome that in some ways with tax policy, and there's ways of getting around it. But ultimately, what's important is that the information that the currency is giving you is clear, that you can understand what a price actually means. That and you're avoiding the situation of seriously high inflation, where people are just confused as to, well, I don't know what, if I get paid $1,000 this week, next week it may only be worth $800, so I'd better run out and get rid of this money as fast as possible. And that doesn't work. It's not the function of money.
So the Phillips Curve, low inflation and low unemployment, I have a feeling these decoupling. Low interest rates are creating credit and asset bubbles. Now that's something you and I might argue on, I'm not sure, but I have a feeling that a lot of this money is being pushed into housing bubbles and credit bubbles.
The Phillips Curve was a good idea when it was made, and like a lot of these good ideas in economics, they're perfectly fine if you use them as indicators and as a way of understanding what's going on. But as soon as you start trying to actually manage the economy based on the Phillips Curve, you see that you see that the inflation rate is dropping, the unemployment rate is increasing. Therefore, we need to start shoving huge amounts of money out into the economy to bring in unemployment down. All that happens is that it goes from being a curve to being a straight line starting at the origin. So instead of being, I'll try and draw it. Instead of being like that, it becomes like that.
Yeah.
So, you end up with it being completely useless, or in fact worse than useless, because you end up with, as soon as you use it to actually try and manage the economy, people recognize that, oh, hold on, unemployment's going down, they're going to start pulling money back in, we'd better start pulling our own investments back, and then that destroys the whole point of the trying to use the Phillips Curve.
Yeah, absolutely. So, this is how I see it. The RBA is incentivizing households to switch from being savers to borrowers. So again, like before, we've seen this a few times. You use your house as an ATM, essentially.
Yeah.
And they're doing this primarily through the residential property market. Household debt levels and property prices have surged since 2011 as the RBA slashed 3.5% of the cash rate. So houses as ATMs, that's what they want, right? But people are leveraged. There's too much debt in the system already, isn't there?
Yes, there is. And that is largely driven by the fact that interest rates are as low as they are. People tend to be quite rational about these things, and again, to use Mises, people respond rationally to incentives. You give them an incentive, go out there and borrow lots of money against their house. and they know they're only going to pay 2 to 3% interest on the funds they draw, then they're going to go and try and find something to do with that money. So they're going to plunge into the stock market, driving the stock market to record highs. They're going to maybe go and buy for the wealthier end of town. They're going to go out and buy a work of art. For the more average purchaser, they're going to go and buy themselves a V8 or something like that. It's a rational response to an incentive. It doesn't. What it doesn't do is actually create any real value in the economy, because you're then going out and doing things that make no long-term sense.
Yeah, absolutely. That's how I see it too. Because like a lot of the wealth in Australia and in Australian context is concentrated in sort of older generations, and these people don't want to take risks. They did all the risk part in the younger part of their life. That's how they got to where they are, and or their families have done all the risks to pass it all on and accumulate that wealth. And now the government's saying, hang on, we're not going to give you a safety net by allowing you to live off your savings. We want to squeeze savers, squeeze them to death, and push them back into risky assets. Risky. You're not allowed to do term deposits. Bonds are useless. And where do people go? So they go back into the stock market, right?
Yeah, and the ALP's policy at the most recent federal election was to then further tax those people who did go into the stock market as part of their superannuation fund, and they wanted to take more money off them. It's that eternal cycle that people find where the government is not taxing them too heavily, and they'll start moving there. And then what happens is the government moves in there and taxes them, destroying what they've done in the first place.
And this is a really interesting argument, because if you look at the Australian economy, it's not a very diverse economy. There's I think like it's like the top 5 or 10 companies are like 5 of them are banks. There's one medical. There's a couple of like mining.
BHP and Rio.
Yeah, it's a very like undiverse economy. There's like not much there. So you pull a couple of those strings out, and you've got like, I think like on the diversity index, like we rate somewhere in line with Nigeria or something. It's crazy undiverse. So you pull one of these pins.
That's not necessarily a bad thing. It would be better probably if it was more diverse, but as long as you've got the capacity to absorb the shocks that come from not being diverse. And if you're making, I'm just using an example here. Let's say you're making $100,000 for 5 years in a row, and then make zero for 2 years. That's better than earning $50,000 a year every single year. It's a matter of being able to deal with those 2 years that are bad returns, rather than saying, well, we've got to get rid of the $100,000 and make everyone poorer.
Absolutely. So we'll keep moving along because we've got a lot to cover, but
yeah, sure.
This is fantastic. So impacts on entrepreneurship is, I think that's going to be bad. There's too many zombie companies already. They're just bubbling up because of the low interest rates, because of the fact that they can front run the interest rate essentially. Yeah. What do you think of it?
If I can add, I'm actually pretty happy with the cut in the RBA's rate, because my mortgage is going to drop.
Oh yeah. Most people with mortgages are.
Yeah, but the problem is then that most of the people who are actually lending to the banks, the depositors, are making less income, and they're generally, as you said, the elderly, which means that they're going to start having to rely more on pensions.
Absolutely. So on this thing, do you think people do you think that are you going to like? Do you think people who are in that situation where now they have less to pay for their mortgage, are they going to put more towards consumption, which is what the RBA is thinking, or they're just going to pay off their mortgage quicker? Because I know which one I would do.
Well, what little extra I get out of it, I'll be putting into debt reduction. Pay off mortgage, or maybe get the credit card balance under control a little earlier.
Which is exactly what they don't want.
Well, that's the problem with this Keynesian thinking of the way that money and the economy works. That somehow putting money into a savings account or reducing your debt is a bad thing. It's not. It's a good thing. It frees you up to be more able to deal with those 2 bad years.
This show is called Imagine the Detonation. Imagine a world without debt. It's not an argument that get rid of all debt so that all debt is evil. That's not it. It's reversing this Keynesian argument.
Debt is a very useful tool.
Absolutely.
It's something that does absolutely help if it's managed correctly and you do it for the right reasons. Trying to save up enough money to buy a house when you're 20 doesn't make much sense. It's not going to happen. You're going to be renting for most of your life. Whereas if you can go to a bank and get a decent mortgage, and that's something that you can deal with, you can get a house much earlier, and this is a good thing.
Because when you're young, your expenses are pretty much unlimited, and as you get older, your expenses become more and more limited, and you should be focusing, and your income grows as well. And when you're young, you've got a lot of expenses and you've got a low income, so you've got to try and figure out how to.
That's basically the function of a bank, which is to use the economics term to sort out the intertemporal differences, where people who are wealthy have a lot of money and don't need more housing, whereas people who are young don't have much money and need housing. And the bank effectively takes the money from the people who have too much of it and just want to get some nice return on it to put into to give it to those who or give in inverted commas, because there's always a payment for it. Give it to those who need it at the time. That's the function of a good bank.
Yeah, and the thing is, like, if people think like you and I did, like, and you're a business people, and if you're a business person, you think like you and I did, which is a lot of people, and they're throwing their money at the debt and not at consumption, and that's what my argument about here is about entrepreneurship and innovation not being as high, because the businesses aren't taking on massive loans because they're not stockpiling stuff in their warehouses expecting a bunch of sales. They go, well, interest rates are dropping. Back in the old days, way back in like the 1950s, that might have been a good thing. You might have gone, well, now we're going to sell lots of products. But that's no longer the day. Their stimulus has run out. We're on the end taper of the Ponzi scheme stimulus thing. I don't know what's going on.
Well, to me, in many ways, I like to compare it to the heroin of the economy, where you're constantly pumping in more and more debt by reducing the interest rates further and further. You end up with the economy acting like a junkie. It simply can't handle more of it, and it takes a while to clean everything back out again.
Andrew Reynolds, can you please demystify fractional reserve banking once and for all? Can you get this out of our system? Sure. Can you explain to the layperson how it's not a giant scam, it's how it works?
Yeah, sure. All that fractional reserve banking is, just to deal with a couple of the comments that come along all the time, to say that somehow the banks are printing money or that they're using accounting to create money. They're not. All that's happening, and it's really simple. All that happens is you walk into a bank and deposit money. There's a few thousand other people who go in and deposit money. The bank also has some money from its investors. They then lend out. Let's say it's a small bank, so you can under Australian prudential rules lend out about 90% of the money that's been deposited with you. The other 10% you have to one side. Those people that you've lent the money out to then go out and start buying things with it, doing productive things, getting on with their lives, buying houses, using their credit cards. Businesses will use the money to invest in their businesses. And then when someone else has received the money, they go and deposit it back in the bank again. And so you end up with, from the original $100 that was invested into the bank, you end up with $190 worth of assets in the bank. It's a little different to that, but let's say $190 worth of in inverted commas money in the system, because the original $100 worth of deposit is there, and the $90 that has been redeposited into the bank. So that's all the fractional reserve banking is. There's that additional $90 is then, $81 of that additional $90 is then lent out again. and that goes out and does useful things and comes back in again. But that's all it is. It's just a matter of the same money going around in a cycle, and all you're doing each time is to say, well, okay, we've got $100 that goes in, we add that in, and it goes in again, that goes in, so we add that in. There's no magic, there's no mystery here. It's not you and I, if we wanted to, and let's say we needed someone like John Humphreys to join us, so we had 3 people. We can easily create money that way. It's not that hard. In fact, it's one of the easiest things on the planet to do, because all it involves is you lending me money, and me giving you a promise to say, look, when you want it, come and get it. I then take most of that money and lend it out to my mate, because I know that I've got a decent amount of money in my bank account, and that I'm more than likely to be able to meet your request for $100 as and when you do it.
So when people talk about strengthening the banking system by raising the reserve requirement, what is that a valid argument, or is that just talk show nonsense?
It depends. As with a lot of my answers, it'll start with it depends. The reserve requirement at the moment is variable depending on the bank, and there's two real reserve requirements that banks have, and it's important not to get the two mixed up, but almost everyone does. One is the capital requirement. This says that for every, let's use the small numbers again, for every $100 worth of loans out there, you need to have investors' funds of around $4, so that if one of the people who owes you that money can't pay you back, that the investors lose the money, not the depositors. So that the shareholders effectively are in the first loss position. That's a capital requirement. The other is the cash requirement. So you've got to have the way the Reserve Bank in Australia calls it, or rather APRA, the Australian Prudential Regulatory Authority, calls it, is you've got to have a certain amount of high quality liquid assets, HQLA. So these are things that can be readily turned into cash. So money itself is one of them, government bonds, deposits with other banks and so forth. These are things that can be easily turned into cash. So that if people turn up at your bank and say, look, I need my deposit back, I want it in cash and I want it now, if you have a contractual requirement to hand the money over, you can hand it over. So that if there is a run on your bank, you've got some money that can be used to meet those depositor demands. So those are the two requirements. The one that most people fixate on, and to an extent this is fair enough, is the cash requirement, the HQLA reserve requirement. You've got to have a certain amount of ability to meet your depositors' demands every single day. And if someone turns up and says, I want all of my money out of the account that I hold with you, that you're able to meet that demand.
Yes. Well, sorry.
No, go ahead.
Oh, I was just going to explain to the audience, like, liquid versus illiquid, if they didn't understand. So liquid is very good, like that's bonds and things that can be easily transferred, stocks.
Cash itself is the most liquid asset.
A ship or a stadium or a building behind me, a car can be a little bit illiquid. Yeah, something that takes a long time to sell and it's very hard to sort of transfer over, or it's very expensive. A diamond ring, a really expensive diamond ring, that's illiquid. Just
to an extent. I mean, let's use the example of that diamond ring. If someone walked up to me and said, "Look, I can sell you this diamond ring. I happen to be an expert in diamonds. I knew exactly what it was worth," and they said, "Look, I'll sell it to you for 50% because I need liquidity right now." You'd probably put your hand up and say, "Yeah, that's." So everything to an extent is liquid. I mean, that building, the buildings sitting behind you are reasonably liquid. If I wanted to sell a building, and I needed the money right away, I can always transfer it. I just have to accept that I'll be taking what bankers call a haircut on the deal. So the faster you want to move the asset, the more you need the liquidity, the more of a haircut you're going to take.
I want to throw you a curveball. Is the 4 big banks in Australia an oligopoly?
Yes, that's no curveball. They are an oligopoly. The question from my point of view is, how did they get there? And to me, that is largely through regulatory action. To me, they've been regulated to favour the big four.
Okay.
And that's from personal experience working for one of the smaller banks, seeing how the RBA regulates the smaller banks compared to the larger banks. It's a lot harder to get approval to do things. You've got to get almost anything approved to be innovative, and if the big four aren't doing it, it's very difficult for you to get that approval.
Yeah, I imagine there's a lot of small banks now. I mean, sort of. Is there more small banks? I don't know, because you see a lot of them. They're all owned, aren't they?
Closed. Some of them are owned by the big banks. Like Bank West is now
Bank
owned
West,
by
that's a good one.
Commonwealth. St George's is owned by Westpac and so forth.
What about MeBank?
MeBank is an independent one that's owned by the Industry Super Fund Group.
Oh, is that what happened with insurance? They went into banking because they were making no money because interest rates are too low. Is that what happened?
Not that I'm aware of. Some of the larger insurance companies did open a banking arm. AMP Bank was operating for quite some time. I think they've now they're not operating anymore. If they're not, they're not operating very noisily. But as part of my studies at university, about 7 years ago now, I did an honours degree, and I looked at all of the ADIs, the authorised deposit taking institutions. Sorry, you've got to use the jargon. All of the smaller credit institutions in Australia, and there were 126 of them from memory at the time. We're now down under 100.
Oh, okay.
So a lot of the smaller ones are being regulated out of existence, and that's been the story consistently since 1959 and before.
Andrew Reynolds, thank you very much for coming on the show. I appreciate it, and every time there's a big RBA story, I'm going to have you on, and we're going to have a great discussion, because I think there'll be more. And if you work for Deutsche Bank, I'm going to keep my. But we could see some action sparks flying from over there, but I don't know.
Yes, I've heard Deutsche are having some problems, and likely to do some winding up in the US at the moment.
Yeah,
they had some really global ambitions and spent a lot of money. And I'll put my hand up. I'll say I was very pleased to receive some of the money that they were spending on systems analysis and internal control mechanisms. I was paid very nicely by them.
That's good. You're backed by the German taxpayer. I mean, which is backed essentially by Europeans. Thanks, yes. Mediterranean. Thanks, Greece.
Thanks, guys.
Hope they're not watching.
They had some very big ambitions, and they have not been realised.
Andrew Reynolds, thank you very much for coming on the show. We're going to have you on.
My pleasure.
Thank you very much.
Have a good one.